Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market briefing, macro trends, positioning, and equity rotation. This video presents a direct informational narration of the source document. All right, let's dive right into the data from June 16th. U.S. market indices really showed a mixed bag of performance. What we saw was that weakness in large cap and semiconductor stocks offset an overall improvement in risk sentiment, which was actually driven by developments over in the Middle East. Because of this, the S&P 500 and NASDAQ closed lower, while the Dow Jones managed to close higher, getting a nice push from cyclical stocks. Here is our quick roadmap. We're going to cover global macro, institutional sentiment, CTA models, sector rotation, the massive SpaceX IPO and MANGOS, and finally wrap up with some specific equity highlights. Section 1. Global macro and commodities. The current market divergence is honestly pretty stark. The Dow rose, completely bucking the broader trend as capital flowed right into consumer and financial stocks. But on the flip side, the S&P 500, the NASDAQ, and notably the Russell 2000 all faced some significant sell-off pressure, getting weighed down heavily by tech and semiconductors. The S&P 500 itself ended up just trading sideways, right above the previous day's gap. That basically tells us key market participants are just hanging out on the sidelines, waiting on those upcoming Federal Reserve meetings. Looking internationally, the Bank of Japan officially announced a 25 basis point rate hike. But you know what? Traders are looking at this and perceiving it as totally insufficient to actually halt the ongoing depreciation of the yen. The general market consensus suggests the BOJ might need to step up and take much more decisive action to support their currency and curb inflation. So, as a direct result, Japanese government bonds fell, and the yen actually gave back some of its recent gains against the US dollar. Shifting gears to the energy markets, crude oil just took a massive plunge, driven by three intersecting supply and demand factors. Let's start with supply. There's the real potential for Iran to immediately resume oil and fuel exports if a prospective agreement goes through. Adding to that, Qatar Energy expects to restore 50% of its liquefied natural gas capacity within just a month of the Strait of Hormuz reopening, and 80% within 2 months. Now, looking at demand, China just reported retail sales at negative 0.6% year-over-year. That misses expectations for flat growth entirely, making it the very first negative reading since the pandemic. This continued weakness in consumption and contracting investment in the world's second-largest economy really signals softening global crude demand. Combine that softening demand with the extra supply we just mentioned, and you get some very heavy downward pressure on oil prices. Section 2. Institutional sentiment and risk. This is fascinating. This data from the latest Bank of America Fund Manager Survey highlights a dramatic shift in how institutions are perceiving tail risks. While a second wave of inflation is still the top concern at 34%, the fear of an AI bubble has spiked massively to 28%, and that is up from just 5% 2 months prior. On the other hand, with some potential stabilization in the Middle East, fears over geopolitical conflict have completely plummeted from 44% down to just 12%. So, how is this shift in risk perception actually altering portfolios? Well, according to Bank of America's strategist Michael Hartnett, while investors remain generally bullish, the fervor has definitely cooled off since May. Fund managers have slashed their net overweight positions in global equities by 12 points, bringing it down to 38%, and they cut their tech overweight to 26%. At the same time, average cash levels crept up slightly from 3.9% to 4.1%. Basically, as the slower summer trading season rolls in, traders are actively taking chips off the table and locking in their unrealized profits. Section 3. CTA models and triggers. Let's move from discretionary managers over to algorithmic trading, specifically diving into the latest Goldman Sachs CTA, or Commodity Trading Advisor models. The model is telling us that short-term S&P 500 long momentum for these CTAs is practically exhausted, and technical rebalancing is starting to exert some mild pressure. Over the next week, no matter which way the market goes, CTAs are projected to be net sellers. If the market is flat, they project $2.54 billion in selling. If it goes up, $3.23 billion. But here is the kicker. In a down market, that selling scales up to a staggering $50 billion. This outlines a wildly asymmetrical risk scenario. Flatter upward markets see very minimal buybacks, but a downward break triggers a cascade of automated stop-loss selling, potentially unleashing anywhere between $46.7 billion and $50 billion in downward pressure. So you might be wondering, what exactly triggers all that automated selling? The critical short-term CTA trigger is defined right at 73.22. The medium-term trigger sits at 70.38, and the long-term is down at 66.18. But 73.22 is the most sensitive immediate level we're watching. This trigger is closely tied to the 50-day moving average, which currently sits at 72.85, but is curving upward and projected to hit that 73.20 area in just a matter of days. Constrained by all this looming automated selling pressure, the mainstream market expectation is that the S&P 500 is going to trade in a tight 7,400 to 7,550 range over the next 1 to 2 weeks, and it's really going to struggle to break higher unless we get some kind of unexpected signal from the Federal Reserve. Section 4. Sector Rotation Dynamics. Now let's break down the sector rotation that the Goldman Sachs trading desk is currently observing, which, by the way, has been the core driver pushing the Dow to those record highs. The source lays out a really clear, explicit, logical bridge here. The prospect of peace in the Middle East directly caused international oil prices to plunge. That drop in energy costs put a severe dent in inflation expectations. As the market starts looking past the short-term inflation data, it strips out those rate hike fears and competently pivots right toward rate cut bets. This exact sequence of events is driving capital straight away from the heavily crowded AI narrative and into traditional value, financials, industrials like JPM and CAT, and cyclical stocks, finally allowing them to play some rapid catch-up. Meanwhile, that super crowded AI trade is going through a healthy liquidity drain, which we can clearly see with the Philadelphia Semiconductor Index recently dropping 5.71%. Section 5. SpaceX and the MANGOS Era. We are witnessing a truly seismic event in the markets right now, the historic SpaceX IPO. The metrics here are absolutely staggering. The stock surged over 16% intraday at one point, marking days of just explosive gains. Since going public, it's already up 50%, pushing its total market cap to an unbelievable $2.66 trillion. That makes it the 5th largest company globally, casually surpassing both Tesla and Amazon, sitting only behind NVIDIA, Alphabet, Microsoft, and Apple. Just to put that into perspective, according to Vander Research, retail net buying in just the first 2 days of trading equaled the entire market's net retail buying from the previous week. Plus, there are massive passive inflows imminent, with upcoming index inclusions in the NASDAQ 100, as well as global benchmarks by FTSE Russell on June 26th and MSCI on June 29th. The sheer scale of SpaceX is actually accelerating a major shift on Wall Street. We're effectively seeing the era of the Magnificent Seven coming to a close. A new framework is taking over, popularized by research institutions, and it's called MANGOS. That stands for Meta, Anthropic, NVIDIA, Google, OpenAI, and SpaceX. While the Magnificent Seven was really focused on the mature cash flows of the mobile internet era, MANGOS is all about emphasizing a brand new pricing framework built on AI foundation models, AI computing infrastructure, and space-based communication and data networks. It's a whole new ballgame. And you bet this speculative frenzy has aggressively spilled over into the derivatives market too. On the very first day of SpaceX options trading, Trade Alert data showed a whopping 115,000 contracts changing hands in just the first 10 minutes. The call-to-put ratio is sitting at a highly bullish 1.7 to 1. Because of all this extreme underlying price action, implied volatility is exceptionally high right now, which makes the options very expensive. All of this activity creates what we call a gamma squeeze. Essentially, as traders buy up these call options, the market makers who sold them are forced to go out and buy the underlying stock to hedge their own risk, and that artificially accelerates the stock price even higher. Passive buying basically locks up the float, maintaining these sky-high prices. The first true pullback is expected only after those index inclusions are finalized, and then a second, probably much more severe wave of selling is anticipated when the 6-month lockup period expires and restricted shares finally flood into the market. Section 6. Individual Equity Highlights. First up, it's really interesting to note that despite the massive liquidity absorption from the SpaceX IPO, the broader market's VIX volatility index actually plummeted from its highs all the way down to 16. So instead of draining the market, the IPO acted as a catalyst, signaling a huge return of capital to risk assets across the board, which actually helped push semiconductor stocks to fresh new highs. The heavy volume in VIX put options strongly suggests that the market is actively betting on volatility continuing to decline as those protective hedges get unwound. However, not every stock got to ride that wave. Take Lunar, for example. It saw its share price cut completely in half from its previous high of $46.08. This brutal decline is tied to 3 distinct catalysts: a major loss of NASA contract share to its competitors, significant equity dilution from a new share issuance, and the severe liquidity vacuum that was created by all that capital rotating straight into SpaceX. But Even after taking a 50% haircut, the stock is still up 44% year-to-date, which tells us it was priced incredibly aggressively to begin with. Keep an eye on 16, though. That's going to be the next key technical support level to watch for any potential bounce. Next up is CBOE Global Markets. Interestingly, even though CBOE was the first to launch those SpaceX stock options, its own stock price actually dropped, breaking down below both its annual moving average and its 50-week moving average. The main driver here is mounting concern over new competition. Coinbase is launching perpetual contracts, and Polymarket is reportedly seeking CFTC approval to offer prediction products on stock market directions. As institutions unwind their market hedges in this new low-volatility environment, CBOE is losing its appeal as a downside hedge. If it can't reclaim these levels pretty quickly, we could see a potential further downside target hitting the 20-week moving average, which sits right around the $230 mark. Moving over to the AI infrastructure space, RXT closed up 5%, bringing its mind-blowing year-to-date gain to nearly 540%. This latest jump came right on the heels of an agreement with AMD to deploy an initial 30 megawatts of AMD AI computing resources across Rackspace's global data centers, rolling out in phases from late 2026 all the way through 2028. This deal is a big deal because it's cited as a key signal that large-scale AI inference demand from highly regulated enterprises, think healthcare for instance, is finally entering the true industrial implementation phase. Finally, let's talk about Western Digital, ticker WDC. It just experienced a 2-day jump to hit new intraday highs. This move is directly supported by a recent Morgan Stanley IT hardware report, which maps out an immense ongoing supply and demand gap for hard disk drives, all driven by global data centers. With HDD demand growing at 40% to 50% annually, and supply only managing to increase by 30% to 35%, Morgan Stanley projects that the severe hardware boom cycle is going to extend all the way out to 2028, giving some high certainty for continued price recovery. So, taking all this data into account, it leaves us with one very compelling question to ponder. Just how long will this AI-driven hardware supply constraint continue to dictate market leadership?